We are very excited about the future prospects of the American income portfolio. 2022 was an unusually poor year. It was really the first year on record where both sides of that barbell, the credit risk and the interest rate risk, performed particularly poorly. Fixed income being a more mean reverting asset class makes it much more likely that in 2023 and for the next several years, we're looking at much more robust returns.
2023 is a year that we expect growth to moderate. We expect central banks to be towards the end of their rate hiking cycles, and we expect inflation to move lower. Right? As we move into 2024, we're going to be coming out of what will be a very slow growth year. Inflation should stay under control. Central banks should be able to reduce interest rates, and that should really set up for a very nice, we think, bond market performance right towards the end of 23 into 2024.
If we want to be efficient with the delivery of a high level of income with a focus on capital preservation, risk management is key. Some of the best ways to do that when we build a portfolio are to make sure that we're taking advantage of the efficient ways to generate income. That's to focus on credit risk and duration risk. Those two things are normally negatively correlated in normal or stressed markets. We think that as investors start to de-emphasize inflation risk and start to prioritize growth concerns, the probability of that correlation going back to a low to negative state, the long-term expectation increases meaningfully. And that's why, looking forward, we're optimistic about American income to generate a healthy amount of income, but to also be very structured for a less liquid market in today's world.
What's really important about the American income portfolio is that our universe is very vast. We span the entire sea of fixed income on a global basis, whether it's government bonds or corporate bonds, both investment grade and high yield, emerging market debt in all parts of the world, securitized assets in residential housing, commercial real estate, other structured obligations. We're looking at it all. And there are times where a lot of it looks attractive. There are times where a lot of it doesn't, and you want more diversification. The beauty of the American income portfolio is we have a very disciplined process for assessing all those risks and blending them together in the portfolio in what we believe will be the most optimal way.
We think duration right now is under-owned, and that people should have more in their portfolios than they've had the past couple of years. Right? That tends to work really well if we go into a recessionary environment. We think there are opportunities in some of the defensive parts of high yield. We think you can buy, names like healthcare, for example. We think there are opportunities in the triple B space in investment grade corporates, especially in the front end of the curve, where yields are still materially higher than the back end. There are some good stories in emerging markets that are starting to show themselves, amidst all the chaos, that we've had in that asset class. So that's an area that we are starting to look a little bit more closely at. So again, having a multi-sector portfolio really allows us to kind of really pick opportunities and to really pick where we think there is alpha, even in these different markets.
Managing American income over the last 30 years, we've navigated many different challenging environments with interest rates increasing and credit spreads widening to deliver a high level of income to our clients in a consistent manner. With currently elevated yield to worst and our approach to managing risk and building income-centric portfolios, we're confident to deliver efficient solutions to our clients looking forward.
投资一定有风险，基金投资有赚有赔。申购前应详阅投资人须知或公开说明书。